changed it, right? So if you look at the current fixed deposit rates, offered 2.5 to maximum 5.75 to 6%. And we all kind of, to get that higher return of 0.5%, 1%, try various different avenues in terms of, and invariably take so much more risk that we are not willing to take, right? So maybe something is on the credit side is far more riskier, but giving you that 1% higher return, we all kind of move towards that because, it is at the end of the day called a fixed deposit. There are various risks that entity or that financial institution may go bust. What happens to your money? That 1% return is not worth that risk that you take going into such kind of instruments. And if you see, it's not now. It's right from 1990s, 2000s. We have seen that FD rate slide. What we were comfortable with 10, 12% interest rate regime has now come down to around 5% kind of regime, right? So falling interest rates and earn us a better return, right? So don't take over risk that or that to for a paltry amount of 0.5% or 1% and go into places which you don't understand the risk of and therefore invariably take a lot of more risk. And I think it is common across India. We are kind of some conservative mindset, and therefore, the assured return kind of pulls us through, despite knowing the facts that it doesn't do us a favor. It does injustice to our hard-earned money, right? Like 53% of household financial assets are in deposits. And it's not only today. It's since 1980s, 1990s, we have seen this trend persist. And it's so ingrained in our psyche that we invariably tend to move towards that area. The only place where we kind of made a right move was around 16, 17, where our proportion of cash and bank deposits fell significantly and the proportion of other assets increased significantly larger. And that is the way we need to move about, because FDs at the end of the day are a losing proposition. And I will show you why. First, when we look at fixed deposits overall, what happens is, what are the benefits that we are kind of attracted to is assured returns, the most and the biggest, because we know that at the end of the term, we will get that return, right? Second is, there is, earlier a deposit insurance of 1 lakh rupees, now increased by the government to 5 lakh rupees. So to that 5 lakh rupee, there is an assured of your money you're not losing your money, right? And there are possibilities of getting a loan against FD, which is again a very bad combination, because in the FDs, your LE is earning low, and on top of that, when you take a loan, it will be at least 2 percentage points higher than that, right? But we kind of get that comfort that there is a loan available in its fixed deposit. Now, what are the disadvantages of a fixed deposit? Firstly, returns are low, and as we have seen in previous slides, that is been falling and currently at very, very low levels and doesn't keep pace at all with the cost of inflation. And therefore, the real returns that we get, which is returns on your fixed deposits minus inflation, is low or at most times negative, right? So you are on a real basis earning a negative return by doing that fixed deposit. We'll show you hard numbers for that. It is insured only up to 5 lakhs. What about that? What if there is a systemic crisis? What if there are many financial institutions going bust at the same time, right? What happens during that time? You are only insured up to 5 lakh rupees. And if you have 25, 30 lakh rupees parked in a fixed deposit, then what happens about anything above the 5 lakhs? It's not insured, right? What happens? There is liquidity, but it comes at a cost, right? If you're doing a FD at 5%, and if you want to premature withdraw that FD, you end up paying a penalty on it, and therefore your real returns are even lower than what is stated on your fixed deposit, because you get a card rate. And card rate, say if you are doing a 3-year FD and you're unlocking in say 6 months, then you get what was the rate prevailing at 6 months, which will be not 5% or 6%, but around 3%, right? And the biggest issue with fixed deposits is they are not tax friendly. Whatever is your tax slab, you are being taxed based on that, right? Whenever you get interest, you kind of pay tax towards it, right? So if you're a 30% bracket, you get a 30% tax on your fixed deposits. So it's not efficient from a taxation perspective, not at all. These are hard numbers one should look at each time when you make an investment. When you make an investment, one thing is common, right? Your cost of expenses, your expense level, your inflation keep inching higher. It's like the meter of a taxi or a rickshaw, which kind of keeps ticking no matter what are you moving or you're not moving, right? Similarly, cost of inflation doesn't matter, doesn't care whether you're earning enough or not. It will keep ticking at its own pace. Your household expenses in 1990 was just short of 24,000 rupees. Today in 2020, the same consumption basket, same kind of expenses towards food, expenses towards travel, expenses towards education, expenses towards clothing, footwear, all that combined makes your consumption basket. What used to cost you 24,000 in 1990 have increased all the way to 4,27,000 in 2020. That's an increase of 10.1% every year. Even from 2015 to 2020, it has been 9% every year, right? So what inflation numbers you see out, 3, 4, 5%, doesn't really match with the spending we all are doing. Our expenses are increasing by 9, 10%, right? Offload higher, it was higher before. Now inflation has come down a tad, but it's not like 5, 6%. It's around 9% today still, right? Gold prices have more or less kept pace with the spending basket. Spending basket has increased by 10%. This has increased by 9.4%. So to an extent, it has kept pace. Small increase in prices going from here will kind of match that spending increase that we have seen, right? Equities have done phenomenally well, right? You needed 33 units of your equity investment in 1990s. Today, you only need 9 units of your equity investment. So equities have grown by 14.9%, helping you to increase your standard of living over time because it has increased more than inflation. Fixed deposits, you required 22 units of your fixed deposit to buy that consumption basket in 1990. Today, that same thing is needing 73 units of your fixed deposit basket, and it has grown only by 6% per annum. So on a real basis, you have lost about 4% every year since 1990 to on the same spending basket if you were in fixed deposit, right? Fixed deposit, we have assumed that it is quarterly compounding, which is not usually the case, and we have assumed a tax of 30%. So if you're at 30%, this is very much applicable to you. So 6% has not done you a favor. It really shows you that it has been a losing proposition, putting your hard-earned money in fixed deposits. But what do? We want something that can help us here, right? Like other assets have done well. Should we just move to those assets, right? Like equities have done phenomenally well over the long run. Should you go into equities completely? The answer is no. And there are valid reasons for that, right? Look at equities, the blue box. It's been very, very volatile. Like 2006, 2007, phenomenal returns. 2008, whatever value you had made sitting in equities declined by half, right? So it kind of moves all over the place. Returns are very, very unpredictable, very, very volatile, and therefore you can't put all your money in equities, right? Bonds at the same time have given sometimes higher return, lower returns. They, in a way, have not given since 2006 a negative return out there. So to some extent, you could rely to some extent on bonds, but returns are again lower, right? If you look at the returns, it is usually lower, or on a whole period, it will be lower than your inflation probably. Gold is a great asset, but again, it's volatile, not to the extent of equities, but again, still volatile, and it has its own cycle, right? So if you look at different points in time, there are different asset cycles originating from optimism and pessimism of each asset classes. Sometimes you have a debt rally in 2001-2, then you had an equity rally from 2003 onwards. Then 2008 onwards, you had the gold rally significantly. So these different periods, different asset classes had their own cycles. So something if we can do that utilizes these market cycles to your advantage, and at the same time ensure that as the cycle matures, you kind of lower your risk at each time. Then that is a great combination that you have, which will ensure lower volatility and a great return for you, right? But that is easier said than done, right? That sounds awesome. That sounds super. That I can be in equity at this time, I can be in bonds at this time, I can be in gold at this time. But it's very, very unpredictable. Why? Because if you see since 1994, there have been different phases in market, right? Right. For example, there have been different crises that we have seen, and some were really, really unpredictable, right? Which we call as black swan. Typically, markets will tell you all these are black swan, but not really, right? Many of these, we knew we were heading towards that side, right? So many of them are predictable, and therefore you can time those cycles well. And some are really surprises, which no one can time, right? Like example, 9/11 attacks in the US. Markets fell after that. SARS in 2003. No one could predict that kind of a pandemic coming. Demonetization. No one could predict that such a move any government could make. And 2020, the COVID crisis, no one saw it coming in a big way, right? So to some extent, you can price many of these things. Some are unpredictable, but we'll have to live with it. But there are ways you can overcome these kind of issues as well. So, is there a way? The kind of the asset cycles you saw, the kind of market cycles you saw, is there a way we can mix all that and give you something that can give you a better return and then your fixed deposits, and at the same time not take too much risk? Because that is what why we are in FDs, right? We don't want to take over risk. We want predictability of performance, and therefore we are in FDs. So when we are looking for options to FDs, right, what are we looking? Are we looking at better returns? Are we looking at low volatility? We are looking at better predictability. I know after in a long term or a certain period of time, I know what my returns are going to be. It could be plus minus 0.5%, 1%, but I know what's the range going to be, and something that protects your downside. That is exactly what you're looking for today. You're looking for options for FDs, and these are the trades that I think each and every one of us will be more comfortable with and willing to part if these things are a tick mark out there. Better returns, lower volatility, better predictability, and lower downside risk. So as I was showing you different cycles, every asset goes through cycles, and each cycle there will be a valuation metric, right? And that helps you navigate these markets. For example, a simple allocation, like for long term, since 2004 till now, equities have given you 12.5% return. Debt has given you 7% return. Gold has given you 11.4% return. At the same time, equities, the biggest fall that equities saw was 56%. Debt saw a fall of 6%. And gold saw a biggest fall from 2004 till now. The biggest fall that it saw in a particular period was 25%, right? So much lower. So what this tells you, and another thing that you can look at is volatility, how the prices move in a particular time, right? So equities has a volatility or a swinging factor of 22%. Debt has a swinging factor very low of 3%, and gold has a swinging factor of 17%. So if you were to just combine equity and debt, you could have got a return. This is a 60-40 portfolio, a 60% in equities and 40% in debt. your returns would have been 11%. Your volatility, the swinging factor, which equities as 22%, it would have been reduced to 13.5% because the swinging factor of debt is much lower. And the biggest fall that equities saw, 56%, would come down to 36% because debt's fall is much lower, right? Similarly, if you, instead of two assets, equity and debt, if you were to combine three asset classes, equity, debt, and gold, right, you still would have made better return of 11.05%. This is a combination of 40 equities, 40 debt, and 20 gold, right? 11% equities. The biggest fall that you have seen would have been 21%. From 56% of equities, would have come down to 21%. And your swinging factor, volatility as it is called, would have been around 9%, right? But many investors may not be happy with a 21% fall and the 9% swinging factor, right? They would be happy with 11% return. But if they want that lower, if they want the volatility lower and the drawdown lower, what they have to compromise is a bit on the returns aspect. If you compromise a bit on the return aspect, because volatility and returns, risk and returns are two sides of the same coin. You cannot have one without the other, right? But you can limit that risk and still earn a better return, right? So it is nothing but understanding what each of the asset class brings to the table, and a judicious mix of equity, debt, and gold will earn you what you want. That is a better return than your fixed deposits, and at the same time, lower risk, lower swinging in terms of volatility. So equities, we all know, are for long-term growth. Fixed income gives you stability and a regular income, and gold gives you that hedge or diversification against the risk that is out there, the unpredictable events that we saw, right? So if you look at this chart, it tells you that the good prices and good news don't come at the same time. Like, for example, before COVID, markets were really expensive, and therefore suggested allocation to equities would have been much lower, around 25% mark, which is shown by the blue bars, right? In COVID, markets became really reasonable, and it made all more sense to increase your equity allocation. And therefore, something like a 50% allocation in just 1 month's time frame would have got you a better portfolio, and therefore a play on the rebound that we saw last year, right? And therefore a chance to make more money. Similarly, when there are not good times, you need to refrain from taking risk. Like if you see from 2012, barely it has exceeded the 45-50% mark in terms of the equity allocation. And this kind of looking at allocations will help you earn the returns that you want. So take risk only when it accounts for, or whenever it is helpful, or whenever it is screamingly telling you that this is the time to take risk. And you can do this perfectly, right? And that is what we have done in the multi-asset fund. And firstly, before going into details, let me run you through the returns, right? Since inception, return of 9.5%, 7-year returns of 9.3%, 5-year return of 9.2%, 3-year return of 8.5%, and a 1-year return of 16%, right? If you look at the longer time frames, since inception, 7-year, 5-year, the long-term time frames, or even 3 years, it's closer to between say 8.5 to 10%, or farther than 5 years, it's around 9 to 10%, right? In that range. So that really tells you that it is very, very consistent over long time frames, right? Short terms can be volatile, like what you saw 16% in 1 year return would have been, say, 4%, 5%, or even negative in a 1 year. But if you were looking at a longer term, the allocations will help you tide the volatility and give you much more steadier, much more predictable return that you're looking for. So if you look at the orange line, that's a SBI 1 year deposit renewed after every 1 year, right? And the blue line, if you look at, is the quantum multi-asset fund. So what we're trying to do in the multi-asset fund is give you an alternate to fixed deposit while at the same time taking a very low risk. So if you were in the blue line, the multi-asset fund, it's only 336 days out of 3,215 days. That is 10% of the time you would have regretted your decision to be in the fixed deposit, right? And 90% of the time, you would have said a good decision. It has given me better returns than the fixed deposit, right? Usually what happens is we want to park money for long term in fixed deposits, but we kind of keep it shorter term fixed deposit maturities so that we know that there is some money coming to us, which if things are okay, we will kind of go ahead and renew it, right? This is a typical way in which people do their fixed deposits. But if you look at the blue line, and as you saw, FDs were a loosely proposition, a return of somewhere around 9.5% would have helped you on better returns than your fixed deposit and better return than your inflation. And the standard deviation, the volatility, the swinging factor that we saw is just less than 6%. So it shows you that it is a very, very steady line, except episodes like COVID, which was very, very sudden and markets fell by 40% in a very short time frame, right? Despite that, the fall has been very, very shallow. People look at it from a 3-year perspective, right? People park in fixed deposits. They kind of wait it out and renew every year. But look at it from a 3-year perspective, right? If you are in fixed deposits, your trend line of 3-year rolling returns. So each point on the lines are 3-year returns. And in these 3-year returns, it's been falling because interest rates are falling. So you're renewing your FDs and each time booking your FDs at a lower rate, right? So what used to be a rolling return of close to 9% has come down to a rolling return of around 6% mark, right? So the 15% of the time you would have said on a 3-year basis, the FD makes sense for me. But 85% of the time, you would set the multi-asset kind of structure, which is an asset allocation structure, works better for me, right? So this really tells you that on a 3-year basis, time is better. And if you see, there have been return phases of 10, 14, 12% kind of levels, and any point in time, it has not gone below the 0 line. So at any point in time on a 3-year basis, you have never earned a negative return. No matter when you invested, if you're waited out for 3 years, you have never made a negative return. And on an average, we'll look at the average returns in the next slide, you have done better than your fixed deposits, right? So that's the beauty of it, that most of the times you will earn better returns. And if you have the ability to wait it out a little longer, you would earn better returns than your fixed deposits. Biggest issue with fixed deposits is you are taxed at 30%. If you're in a 30% bracket, at 30% on your fixed deposits. Wherein the blue line, if you waited out 3 years, then your effective taxation, even if you're in a 30% tax bracket, your effective taxation, because of the indexation benefits it provides, comes down to less than 10%, right? So whatever you earn, whatever in this blue line and the orange line differential gets further bigger because of the tax benefits that you get on because of multi-asset fund being an instrument which is taxed at 20% with indexation. So effective tax comes down to less than 10%. So this is further a very, very big advantage to all of us who are looking for an alternative to FDs. And this is what I was talking about, right? Even in the bad times, it has given you a return of 1.5% in a minimum basis. And maximum return that you got is 13.6%. So even on a 3-year basis, you have at least earned 1.5%. Maximum return that you would have got on a 3-year basis, 13.6%, which is far higher than your fixed deposits. And on average, you would have earned since 2012 till now, if you were in the multi-asset fund, you would have earned a return of just about 8.7, 8.8%. So that is again better than your fixed deposit. That is at least about 1.5% more than your fixed deposit, while you took very little risk, right? Little risk. Risk is in terms of your capital going or not, right? You're losing your capital or not. At no point in time on a 3-year basis, you would have lost your capital. And if you look at the different asset class, of course, equity has been a clear winner, the green line. But if you see, it's been all across the place, very, very volatile. And you don't know when you will need money. And it could be the time when markets have fallen by 40, 50%, and that is the time you need money. And then you will have to sell your equities for that lower value, right? So to avoid that, look at the blue line, the dark blue line, right? It's a multi-asset fund. It's so steady. It's very, very steady, right? And at the same time, giving you better returns than your liquid funds, than your bond funds, than your fixed deposits, right? So what will determine, what are the things that we look at, and how can you ensure that this trade will remain going forward as well, right? Let us look at asset classes, right? Let us begin with equities. So equities, what is the material? What is end of the day that determines what kind of returns equity makes? Equity markets at the end of the day, no matter there will be speculation, there will be volatility, there will be different factors. At the end of the day, it will move as per earnings of companies that are in the index, right, or in the stock market. So earnings is one thing that tells you, or something that you can bank on, which is very, very fundamental. And that is what we see when we make our decisions. Bank on valuations as a measure to tell you that what can you expect from equity markets going forward, right? That determines our allocation to equities. At the same time, when we are looking at earnings growth, we also look at what level the valuations are today, right? Earnings can be fantastic, but if the market is already pricing in that or not, right? It could be very well that markets are overpricing that strong earnings that are coming, right? So what is the PE ratio? Not only historical, we also look at forward. What is the expected PE going 2 year out? And that will tell us what kind of confidence we play and what kind of allocation we have towards equities. Coming to fixed income, what we are seeing today is there is high level of government debt, right? Government debt has increased because of COVID spending that they have to do, and to pull the economy out of doldrums, there will be a lot of government spending happening, and therefore the fiscal deficit is large. At the same time, we have seen RBI coming in saying that we will help the economy, we'll help the government, we will buy a lot of bonds. So you have the RBI coming and saying that we will remain pressured, we will come and participate and buy excess bonds that are there, excess supply from the government that is there. At the same time, on the other hand, you have inflation inching higher. To what extent the RBI will be able to remain accommodative when there are so many inflation pressures? Look at commodities. A lot of metals, oil, agri-commodities are trading at much higher levels than they were at. Many commodities on the metals and agri are at multi-year high. They are at 8-year, 10-year, 12-year highs. So inflation pressures are real because of the liquidity being pumped in by central banks across the globe. So these are factors we need to keep into account when we are placing money in each of the asset classes. So what kind of return expectations we should have from each of the asset classes. For example, bond markets will not have the good returns that we saw last 2-3 years because much of it is priced in, and there are pressures from high government supply, high inflation out there, and it is only to be seen till what extent the RBI can hold the fort. Coming to gold markets again, gold looks very fundamentally very, very attractive. And why we say that is because if you look at a crude measure of gold valuation, right? Gold at the end of the day is money. And look at the money printing, which is the red line that has happened of late because of the issues in terms of COVID, and therefore government spending a lot more money and infusing a lot more money in the system, giving handouts to everyone, giving support to businesses, and therefore that red line has just moved sharply higher. And gold has followed the suit. But if you see, the red line is still inching higher. The growth rate of money supply in the US is still around 20%, right? And if you see, gold prices have corrected because of the optimism that we are seeing towards economic recovery. And therefore, today, when we look at gold in perspective to money supply, which is, again, gold is a monetary asset, it's a tad undervalued. That really tells you that gold is still an attractive place to be. And we see an environment of real interest rates be negative. What are real interest rates? It's interest rates minus inflation. So whenever we have a realm of negative real interest rates, 2006-7, and therefore even now when we have negative interest rates, gold is doing well and will likely do well because this scenario is not changing in a hurry. So overall, gold looks attractive. So you need to look at what is the forward-looking outlook of all these asset classes and make an asset allocation that has to be unbiased, that has to be dynamic, and that has to be agile, right? When we say unbiased, right, it has to be across asset classes, and it has to give you the flexibility that allows you to move in a range in a wider manner, right? For example, if you were to look at when you say unbiased allocation, the equity allocation that we have in the multi-asset fund is 25-65, debt also 25-65, and gold, which acts as a diversifier rather than a return generator, is between 10 and 20%, right? So you need to have a mix. Many asset allocation funds or many dynamic allocation funds are biased towards a particular asset class. Many of them will have equities minimum at 65%. When you are having equities at 65%, you are taking very similar risk or almost close to risk that you take with your equity investments. Because even if the fund manager doesn't like, they have to stay minimum 65% invested in equities. And that doesn't help you to bring down the downside risk, to bring down that volatility, to bring down that swinging factor, right? You want something as an alternative to FDs, you need to be allocated in a manner that allows you to reduce your risk considerably whenever it warrants to. Second thing is you need to be dynamically allocated. And the biggest thing that you can rely on for which asset class will do well is to bank on valuations. If valuations are high, and I'm not saying only historical, I'm saying a relative valuation or even a valuation that is forward-looking, that helps you to determine how much money to you put in each of the asset class. Today, equities, given all what we are seeing, are expensive. The valuations are expensive. Earnings, there could be uncertainty on earnings. And when you look at in relation to what bonds offer in terms of relationship or relative value between earnings and bond yields, that tells you that you need to have a lower allocation to equities if you were to minimize your downside risk. So at all points, if you are looking to an alternative to fixed deposit, you have to ensure that at each point, you are reducing your risk and returns will come. Whenever there is you cite a risk, you have to reduce your exposure to that risk. That's the bottom line. And that is exactly what we do in the multi-asset fund. So that we can give you a much predictable product where you can park your money for the 3 to 5 year period and earn a better return than your fixed deposits. And today, fixed deposit, although they will give me lower return, it will help me protect and bring stability to the portfolio. And whenever there is a need for me to take risk and go into equities, it allows me to easily switch my investments. And gold, we have a range of 10 to 20%. We ideally use 10 and 15%. The rest 5% we allow for market appreciation only. So we are at optimal allocation in gold because gold is looking very, very attractive. So we are maxed out on gold and have been very, very measured. right? And third thing is to be agile. When things were not warranting in our history of the multi-asset fund, we refrained from taking risk, right? We remained at 45%, 50% allocation. And at times, like times before COVID, market valuations were really high. We did not predict COVID, but we knew that market valuations were stretched. And therefore, our equity allocation was around 25, 26% at that time. And when COVID struck, it gave us an opportunity. We showed our agility. We increased our allocation to equities from 25% to 50% in just 1 month. Within that single month from March 1st to March 23rd, not even a full month, we increase our allocation from 25% to 50%. So when you are watching it every day, when you have your valuations at your fingertips, you are able to take these kind of calls, right? And show your agility and go into that asset class and get the higher returns that you're looking for. And when things get again expensive, we have again lowered our allocation to equities. We don't want to take a risk on your behalf, and we are at minimum 25% allocation to equities at this point in time. And if markets correct, like it did in March last year, we will again, as maybe good for investors, we will increase the allocation to equities. So when you're considering an option as multi-asset fund, what you need to do or what you need to understand before you jump into it is that we kind of diversify across asset classes. We try to reduce risk at all points in time, as I have said. We reduce dependent on a single asset class to generate returns. So we have a broad, well-diversified portfolio. You need not time the markets. We will do it for you, like what we did over last 1-2 years or since 2012. We are watching your risk. And whenever the risk allows us to move and take risk, we will do it for you, right? And you don't have to worry about rebalancing because, whenever there is a need, we will rebalance and therefore book profits wherever it is required. And otherwise, we will let the portfolio run and generate returns for you. Also, it is very, very tax efficient. And especially 3 years and more, it becomes really tax efficient. And one more thing. Even if you're doing your asset allocation on your own, whenever you change your allocation from one asset to the other, each time you pay a tax. Whereas we in a mutual fund, whenever we change the allocation, there is no tax element involved. Mutual funds do not have to pay the tax, and therefore investors also don't have to pay the tax whenever the allocation changes. Only when you book or you exit or redeem, that is the time, depending on your gain that you have made, that is the only tax you have to pay, right? And what we are trying to give you a smoother ride and reduce that swing factor is, as I've said, that the swing factor for multi-asset funds since 2012 is less than 6%, right? So it's very, very low. So it's been a smooth journey, a smooth ride for investors. So as investors, the basic lesson that we all get is what we really focus on, and we don't have control on it, is returns, right? Most of the time, 90% of the time or energy we spend choosing our investments is focused on returns, right? And we have no control on what kind of returns that's going to be, right? What we can control and what we can really focus on is what is the risk, what is the cost involved, what is the time that I will require in terms of what is the holding period that I need to have, and what is the behavioral trade. Do I need to watch it every day or should I leave it on the fund manager, right? That's all in our control and we don't focus on. So when you're looking at an alternative to fixed deposits, look at an alternative to fixed deposits. At that time, don't compare it with equities, because when you compare it with equities, compare also the risk that you get along with equities, right? So when you're comparing, compare apples to apples, oranges to oranges, not apples to oranges, right? So it is time that we all move from the shackles of FDs, because FDs at the end of the day are losing proposition. There are proven ways, there are time-tested solutions out there that ones offer and give it to you which kind of give you that better return. At the same time, protect your downsides, protect the volatility, and therefore give you a smoother ride. You don't have to lose sleep at night just because you are invested in something. Here you can invest, sleep peacefully, and have a better return at the end of the day. So make a prudent choice today. It is extremely, extremely important that you do it. And next time you renew your FDs, you look at booking a new FD, please think about the quantum multi-asset fund. That really helps you get a better return and look at what you are really looking for. So make that prudent choice next time you're thinking about doing an FD. With that, I hope I have added some value to you. And with that, over to you, Russell, and happy to take any questions that you have.
Thank you very much, Chirag. I hope you all enjoyed this comprehensive presentation. If you haven't yet asked Chirag your questions, you can still do that by sending the questions across on the chat. We'll start with the first question for Chirag. For the recently retired people for regular monthly income.
And very, very assured in terms of, because you're banking on it to make your monthly expenses. And if that fixed deposits or something that is fixed, but what mistake that we end up doing is park everything that we have into that same asset or into same instrument. We need to bifurcate what is required for me for that monthly expense needs and what is over and above that I'm not really bothered of, and I can wait it out for say 3, 5, 7, 10 years. You need to bifurcate that and ensure that only to the extent I need in terms of fixed deposit, fixed returns or assured returns to handle my monthly expenses. Only that I put in fixed deposits or any good AAA kind of company deposits or a gilt fund, something of that sort, which doesn't take much risk, or a dynamic bond fund. I will not suggest a dynamic bond fund or bond funds for retail investors because you don't understand the risk. Because the biggest risk in a bond fund is it can also give you negative returns. That is not many people think when they make a debt investment. And therefore, if you understand that space, then only go into that, because bond funds can also give you negative returns, right? No matter it be government securities or GSECs as they are called, it can still give you negative returns because if interest rates move up, that bonds can give you negative returns. So when you're looking for a fixed monthly expenses and banking on some instrument, it has to be something like FDs. But don't club everything into that FDs, right? Something that is a little longer term, you can go down and at the same time take only little higher risk.
Thanks, Chirag. Coming to fixed deposits, there is a provision for extra interest of say about 0.5% for senior citizens. Likewise, in the fixed income schemes of the mutual fund, is there any such scheme now, or can it be devised?
I think banks, if you look at banks that give you that 0.5% or something more returns than what your fixed deposit offers you to senior citizens,